Signal Sciences secures the most important web applications, APIs, and microservices of the world's leading companies, protecting over 7,500 applications and 150 billion production requests per week. Signal Sciences Next-Gen WAF and RASP help companies increase security and maintain site reliability without sacrificing velocity, all at the lowest total cost of ownership. Signal Sciences' patented technology protects any application against any attack, with integrations into any DevOps toolchain. Signal Sciences, demand more from your WAF. Learn more at signalsciences.com/PSW. Let the team at Black Hills Information Security test your defenses. With over 10 years of experience in penetration testing, red teaming, and threat hunting, the testers at Black Hills will help you find the holes in your security before the bad guys do. The team at Black Hills cares about educating and sharing their knowledge by creating countless blogs, open source tools, and webcasts for you to learn more about the tradecraft of pen testing and red teaming. Visit securityweekly.com/BHIS to join their mailing list and view the latest blogs and webcasts from Black Hills Information Security. Effectively securing your organization and its reputation requires a smarter approach. To maximize efficiency and minimize risk, security experts turn to LogRhythm, the only leading solution built solely for security teams by a security team committed to your success. With Next-Gen SIEM, user and entity behavior analytics, network traffic and behavior analysis, security automation and orchestration, and compliance, LogRhythm provides security made smarter. Welcome back, everyone, to Enterprise Security Weekly. That's right, we've heard from our listeners that you love the content, but there's just too much sometimes, and it's overwhelming. Go to securityweekly.com/subscribe. Join our list where we're working on notifying you when content is released that's within your interests. Also, we'll be at Hacker Halted, Atlanta, Georgia, October 10th through the 11th even. EC Council has a 15% discount code even for their bootcamp courses or workshops. securityweekly.com/Hacker Halted. Matt Alderman is with me to talk about. There's been a lot, Matt, a lot of acquisitions, a lot of funding announcements recently. Some pretty major acquisitions. Palo Alto picked up PureSec and someone else, right? Twistlock. And let's see, FireEye picked up Verodin. Breach and attack simulation, which is good for that subset of our security industry. Recorded Future was purchased by Insight Partners, which is really like a wholly owned subsidiary. We'll talk about that and some of the differences. Elastic has purchased Endgame. So a lot of acquisitions. I think a lot of us think, what does it mean for us? But also, I wanted to talk today about the different types. So I don't know where you want to start, Matt. It's up to you whether we talk funding, acquisitions, or where you want to go.
Well, we can probably start with funding because it's kind of the first step as a startup in the industry, right? Is how do I get money to build a product and eventually get it acquired potentially or go IPO, right? Those are kind of the two main paths.
Yeah, and so the question that I have been getting, and I often sometimes ask myself about some of the subtle differences, right, is we talk about the different types of funding rounds. And so you'll see a seed round or an angel round as an earlier stage round. And then you'll see a series A through, I don't know, E or maybe F sometimes. And the question is, what's the difference between all those rounds at the end of the day?
Yeah, an angel or a seed round is an early kind of debt round to get a product started or start to build a prototype. You're not ready for what's called a Series A until you have what's called product market fit. Mm-hmm. And product market fit means you've got customers and you have revenue traditionally. And the magic number to think about from a Series A perspective is $1 million in ARR, right? $1 million annual recognized revenue.
Okay.
The customer counts can vary depending on whether you're more of an enterprise or a small to medium enterprise business. Mm-hmm. There's usually a count, but it typically think about $1 million in revenue. Then I'm ready to go get an A round to grow.
Right. Yeah, and just in our model, the way we've tracked it, right? Usually when a security company gets their Series A round is when they want to do some more formal marketing programs, reach a wider audience to facilitate growth. Typically, that's where we'll start working. There's no golden rule there, too. We work with many early stage and later stage and even public companies. So, but that Series A round, I think, is a very interesting transition point for you as a consumer, you as a B2B, you as a partner, right? Whatever your role is in listening, Series A round kind of marks that the company's got some revenue, they've got some traction, and now they're looking to basically expand beyond their first smaller subset of customers that helped improve that the product is solving a problem for someone, right?
Yeah, exactly. So the A round is going to infuse cash into the business to start its growth trajectory, which typically means sales and marketing,
Right.
because engineering, R&D have already been there. Yeah, you'll scale that, but it's really a sales and marketing
Yeah.
activity when you get to the A round and beyond.
Right. And is there a difference between a seed round and an angel round, or is that really just a same term? It means roughly the same thing?
To me, they're basically the same. You've seen some people call it pre-A,
Yep.
which is an interesting term. Anyways, they're all early debt rounds. And what I mean by a debt round
so what's
is,
the difference between a debt round and an equity round?
yes. So a seed round is really a debt round. You're taking money on the promise of potential equity. So the two traditional ways that most seeds happen is either through a convertible note, which is cash for stock options that vest over a period of time, or a safe note, which is a simple agreement for future equity, kind of like a convertible note. It's a little more, it's a little easier. I've seen a lot more safe notes used, and that is equity for preferred stock at a funding round, an equity round later.
Right. So it's almost like a loan based on you're going to pay that back with equity in the company, provided there's value that's that you've accumulated in that company, right? It's not necessarily a cash payback, although a debt round could be a straight cash payback with interest, right?
It could be. So let me give you a perfect example, Layered Insight, right? We used a safe note to raise our seed round, but because we got acquired by Qualys, the original seed round got a set of payout based on their initial investment, because they never got equity, because we didn't get an equity round, we got bought out. So they got paid back with a certain amount of guaranteed fixed growth/interest in that note.
Right. And you see this on Shark Tank too, depending on how they want to do the deal. They may take a little equity, plus they might do a loan, plus they might do a royalty, and that can all be in some kind of one single investment round, or they could be separate, right?
Correct. And so typically that's how a seed round is kind of more of a debt instrument. Then when you go to a full A, that's when you have an investor really coming to the table, a venture capital firm traditionally, right? And they're going to come in and they're going to infuse cash for a percent of the business. And any of those debt instruments you use then either get converted into preferred stock and or some sort of equity at that point. And that kind of marks the conversion between a debt and an equity round, except for there are debt rounds potentially later, and we can talk about that in a little bit too.
Sure. And so then when you go from A to B to C to D, E, F, G, like however far you want to go, well, I guess the question really is, like B, you're taking more money to facilitate more growth typically, right? So when you start getting above C, I think a lot of us start to wonder, like, what's the future of this company? Are they going to go public? Are they going to get bought? Like they're taking more rounds and more rounds. Like what's going to happen?
Right. And that's exactly it. Is each round has a specific runway of how long that cash will last you is part of your growth plan. And so what you have to figure out then really is, all right, when do I have to get ready to raise the next round? So rule of thumb is a round should last you 24 months, and you should be prepared to start raising 18 months into that equity round.
Gotcha. Okay. Each
round should be looking at a higher valuation for the company so you can raise more capital at preferred equity ratios, right? So you're giving up less equity later on to bring cash in to continue the growth mechanism. But you're right. At some point, you have to figure out what the exit is, because you see somebody like a Docker who's in Series D, raising hundreds of millions of dollars, right? CrowdStrike did this. They raised, I think it was an E round of like over $100 million. But their plan was always to go IPO. So you can raise late short-term rounds at preferred equity ratios, knowing that the exit is to go IPO, because when you go IPO, all those investors have an opportunity to make money, right?
Gotcha.
And so it allows you to continue to raise money over a number of rounds with an IPO potential exit to pay all those investors back.
Gotcha. And one of the things is market capitalization or market cap, right? That's basically based on the market, the potential amount of money that you can make in the market, right?
Yeah, I mean, market cap's calculated based on stock price and number of outstanding shares, right? And investors look at market caps in different ways. They look at it from a price to earnings rate potential ratio. They look at it to compare it to its peers to see who is higher valued. I mean, the perfect example for us obviously is Qualys, Tenable, and Rapid7.
Right.
You look at their market caps and you're like, who's considered the leader, right? Tenable was number 2. They went to number 1. Now they're actually number 3 from a market cap perspective, for example, right? And so it's a way to kind of measure like companies to see who the investors kind of think are in a better position to continue to grow and drive revenue and ultimate value for their investors.
So it's a measurement of growth and revenue.
True. Yeah. Well, kind of. It's really stock price to outstanding shares is how market cap is calculated. But then there's ratios about based on your revenue, what's your market cap to revenue ratios. You've got price to earnings ratios, which look at the price of the stock compared to earnings. There's a lot of different metrics that financial analysts will use to determine which companies they'll invest in the public market and which ones they won't.
Now, sometimes you might see, if you're following the security industry, that a company had a certain valuation. What's the science and or art behind a valuation of the company before we're talking about IPO, right? We're still in the pre-IPO stages. You're going to have some kind of valuation of the company, right? Basically, how much is my company worth?
Yes. And in these, there is no easy answer to this one because I've seen them kind of vary all over the place.
All over the place. You see that on Shark Tank all the time. They're like, you're crazy. The valuation's always too high for the investor's liking, of course, right?
Of course. And this is really hard in the early stages, like in a seed round when you're trying to figure out what the potential equity is. It's really hard because you don't have any revenue yet. You don't have any customers
yet. You might have customers,
so
right?
What value do you put on the company for an equity play? When you get closer to an A, you can start to look at your revenue numbers and your pipeline and say, look, based on this, we think our pre number is X. And therefore, with the investment, our post number is Y. So those are always parts of that initial A round is figuring out what your pre and post valuations are based on your rounds. I've seen them vary across the board. And a lot of it depends on the venture capital firm and how much stake they want in the company, because they also want enough equity, knowing that they're going to have to raise subsequent rounds, that they don't get too heavily diluted because they're taking the early risk in getting you funded. So there's also a percent of equity in those numbers that have to be accounted for as well.
Right. Now, again, if you're following the industry and you work for an enterprise and your company that you work for, it needs security software, right, to protect your enterprise, and you're using vendor XYZ. Vendor XYZ gets acquired. And and there's probably more, but I think of two very distinct acquisitions, right? One is a larger security company buys a smaller, conceivably, security company as an acquisition. The other scenario, and we've seen both these scenarios recently, in fact, we talked about them on the top of this segment, a venture capital firm purchases the security company. You, as the consumer of those services, of that company's services and or products, what does that mean for you? I mean, I know it's different regardless of how they were acquired or for how much, right? But I think there's two distinct ones. Big security company buys small one, venture capital does it and is a wholly owned subsidiary, essentially, correct?
Yeah, and there's a slight variation on the second. It could be a venture capital or a private equity firm.
Okay.
Thoma Bravo's obviously done a number of these types of acquisitions as well.
So it explains the difference between venture capital and private equity as well.
Correct. slight difference. But they basically end up the same, is that they are in the second scenario where a venture capital firm like Insight Venture Partners or a private equity firm like Thoma Bravo comes in and acquires the majority rights, is the company pretty much operates as is.
Yes.
Now, sometimes you can see change in upper management because usually those types of deals are actually buying out the early stage founders in some form or fashion.
Gotcha.
Maybe not completely, but at least partially. And in the case of both of those types of entities, they may want to bring in new executive management to continue the growth and then the eventual IPO or sale of that company. But the company still exists pretty much as a whole with maybe some changes in management. We saw this at Tenable when Insight Venture Partners came in and eventually, Ron left and Amit came in, right? They went out and brought in a new CEO to get ready to go IPO. So that's typically what happens in those types of scenarios.
Gotcha. Now, what's the difference between a venture capital firm and a private equity firm?
I'm going to struggle with this one a little bit because there's some nuances. Venture capital, the way I look at venture capital is these guys are investing in new technologies at much earlier stages, taking much larger risk to grow a company forward to an exit. Private equity is typically a later stage company. They're not making early stage investments typically. They're not taking that kind of risk. They're looking at well-established companies that they like, that they believe they can invest in and grow, but they're in a much more stable, kind of mature scenario.
So Insight Partners is a private equity firm.
Yeah, Thoma Bravo is for sure.
Okay.
Insight could actually kind of overlap.
Yeah, I gotcha.
A combination of VC and private equity. There are some there's some interesting nuances with late stage venture capitalists and private equity firms. And there's a little bit of a gray line there that I don't fully understand the difference between them sometimes versus the early stage guys, which are the guys that are doing A's and B rounds all the time. That's your Allegis Cybers, your Clear Skies, your Forge Points. These guys are early stage investors and go along the ride. Where some of these other guys won't come in until a C, a D round potentially or later.
Right, but that's good to know from the consumer of the products and services that if it's a venture capital or private equity firm or some close, relationship between the two that purchases your security product vendor, likely, there might be some changes in upper management, but for the most part, business as usual. The mission in products will stay the same. They'll probably grow and diversify a little bit, but I think you feel good about that for the most part.
And we have a couple of those scenarios in the portfolio. Logarithm by Thoma Bravo. Recorded Future now by Insight Venture Partners. Well-established companies, been strong partners of ours over the years. I don't think you're going to see much change other than maybe some management changes to help continue those companies to grow. But they're not going away anytime soon.
Right. But now when Palo Alto or FireEye, as the recent examples, purchases a company, or in the case of Elastic and Endgame, we don't know what's going to happen. We don't know how the products will be integrated, just like the Layered Insight acquisition, by Qualys. How the product's going to be implemented, when they're going to come back. There's usually a quiet period, which can range from months to a year or more, where they're figuring out how to integrate the teams, integrate the technology, and they surface back around. Palo Alto has done this several times. All of their newer product lines, in fact, are basically all of the acquisitions they've been strategically making over the past year or 2 years, and now they're reemerging basically as new rebranded products.
Correct. And so when a large security firm buys a smaller security firm, it's part of a strategic initiative to grow their base and grow functionality, whether it's a new product line or to augment an existing product line. Palo Alto is probably the most known for this because they've done a lot of acquisitions over the past year and a half, 2 years, where you're now seeing whole new lines of products coming out that are integrating these acquisitions and bringing them out.
But that's hard. That's hard. I mean, you look at Symantec, Palo Alto, FireEye. I mean, Cisco's got a terrible track record of doing that. We hope that when the technology does reemerge, that it's awesome and it solves problems for people. But I feel like in a lot of cases, when it reemerges, it's not quite the same, and it's not as impactful to the security industry in the community and the consumers of these products.
Yeah, sometimes we do see it that way. I think there are examples with Splunk/Phantom that are positive because they were really close adjacencies. I think really easy to integrate because they already had integration relationships in place.
That's a good example.
Which made a lot of sense. You take somebody like a Twistlock and a PureSec from the container side and serverless architecture side, put it into somebody like Palo Alto that really is only focused on the network side. How does that come to fruition under the Palo Alto umbrella? I think it's still
they said
unknown.
It was integrating with a Palo Alto product. It's not Cortex, because Cortex has a lot of their more network-centric acquisitions. PureSec and Twistlock went into a different product line at Palo Alto. We covered it last week. I can't remember the name off the top of my head. But basically, they sounded like Palo Alto kind of had like a smaller cloud container serverless presence, and they picked up these two acquisitions to really strengthen their product in that space. So remains to be seen.
Yeah, and I think this is where Evident.io and the Redlock acquisition and now Twistlock and PureSec all start to come together more as a cloud app set of offerings. It'll be interesting to see how that goes because the Evident.io acquisition was not successful, which is why they went out and bought Redlock.
Gotcha. Okay.
We'll see how Twistlock and PureSec
play
in this environment.
So if
those
that's
are a little
the case,
harder to know.
If that's the case, if I am using those vendors' products that have been bought by a larger company, you got to have some really go have some meetings with your team, right, and develop a strategy of either choosing some different technology and keeping close tabs on what happens to the technology that you've acquired, because it's likely it's going to change in some way that may or may not benefit you. And those are some conversations you have to have in the enterprise about what you're going to do.
Yeah, when Layered Insight got bought by Qualys, we really knew where it was going to fit into the portfolio. We really knew the value that Layered Insight was going to be able to bring to the Qualys platform. Obviously, John and others have been working to integrate that into the Qualys Guard platform. And that was a really easy for me to see where that product eventually was going to come out and provide value. There's others that I still question, like, how is that going to work? And those are the ones where, I think you might want to have some backup plans just in case.
Exactly. Awesome. Well, that really helps. That was great. I liked covering it from I'm the consumer of the security industry. What do I need to know about all these different types of acquisitions and funding rounds? So that certainly helped me, and hopefully it helped our listeners. So, Matt, thank you very much. Thank you, everyone, for listening and watching this edition of Enterprise Security Weekly. That concludes the show. We'll see you next time.